Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day everyone, how you going? Phil Tarrant here. Thanks for joining us on the Smart Property Investment Show as we try and give some sense to this market, this property market, which it feels like every single man and his dog is in it right now, and it's a good thing. Goes to show, I think, the sort of widening sophistication of Australians to be thinking about their financial future. You know, I sort of straddle, you know, the quantitative and the qualitative insights to help make me a better, I guess, property journalist, but therefore a better property investor. And like to mix the numbers with the narrative. The way I go about framing, shaping my opinions is to dig down in the data and then normally talk to people that typically know a little bit about it to sort of give me some sense of what it is and how I can help communicate that to you, our audience of passionate property investors. And, you know, it gives me a real kick to see how wide and deep this community is right now. And we've got people who are sort of just starting on the journey of becoming a property investor who are just finding us at the moment because they've Googled how to invest in property. And this is a nice home for you to get unbiased information as you shape that journey to those who are more sophisticated investors who have been in the game for quite some time and looking to capitalise on this current market. Everyone's talking about the current market right now. You can't go anywhere without someone talking to you about property, even if you're not really interested in it. But for some reason, people think that I know what I'm talking about when it comes to property, so I'll put it at the front end. I don't. I'm pretty good at talking about it to people who do know what's going on, but hopefully I can help aggregate some of those ideas for you. So don't get caught up, my recommendation, don't get caught up right now making knee-jerk decisions as a property investor. You only need to sort of pick up a paper and someone will be telling you how the way we work as a nation, as Australians, has changed completely, and therefore everyone's going to go live in the bush, or everyone's going to go live in Byron Bay, or everyone's going to go live in Torquay. And if you're not buying property there now, you're going to miss the boat. And, you know, there's no value left in capital city markets. There's no capital left in the city locations. We're in a fractured environment. We're at a fundamental shift in how I think we will continue to work as Australians and how that might change our lifestyles. But it's still too early to work out exactly how that's going to be. Don't leave the capital cities as an investor thinking that you're going to get the best bang for your bucks in the regions. There are some good markets out there, and we like to talk about them on smartpropertyinvestment.com.au. Just be careful in this environment not to make immediate decisions that may shape or change your ability to invest in the future. That's my recommendation. And to help you shape that, you've got to go and speak to people who know what they're talking about. Numbers, you should be across it. Pick up a paper. Everyone's talking about them. What do they all mean? A lot of times they're just decimal points and percentages. That doesn't really mean much without the narrative. So today we're going to try and get into some of this stuff. Just try and help shape your decision-making around that. Joining me in the studio, Pure Property Investment CEO, Paul Glossop, good friend, good long-time guest on the Smart Property Investment Show. He's in the studio with me. Paul, how you going?
Excellent, Philip.
How many people, to my point, are making stupid property investment decisions now because they've got FOMO?
I reckon
is FOMO driving decisions?
FOMO's coming back. I mean, I haven't heard the analogy or acronym FOMO for probably, I reckon it's been out of the papers for the last 4 or 5 years and off the headlines, but it's back.
FOMOP, we're going to call it.
FOMOP, give me the
Fear
P.
of missing out on property.
Oh, good.
FOMOP.
Done.
I got FOMOP.
I got FOMOP. It sounds like a sham wow.
What was a sham wow again? Sorry.
It was a chamois. It was wow. And there's a guy who had the headpiece and he was,
right.
oh, bam, it's a FOMOP. It sounds like something you should be cleaning your floor with.
Is there FOMO in property?
But if there was ever a time where I'm not seeing FOMO per se, but I'm probably seeing more like what you alluded to there with people thinking that I want to go and buy in Byron Bay or Lennox Head or Gerringong or Mornington Peninsula or Broome, all these other markets which all of a sudden sound highly desirable because people think that they're going to be working remotely for the rest of their lives, and that all of a sudden these markets are actually coming to life because there is a lot more people holidaying, and the follow-up of a holiday thinks people can be there more permanently, blah, 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 blah. It's happening. And I'm not going to suggest that regional centres such as those are mining towns per se. However, what we are seeing is that the immediate and almost instantaneous shift from people thinking about fundamental long-term objectives and things that drive property markets over decades have all of a sudden gone out the window, and people are now just thinking it's a great place to live. So therefore, if I can work remotely, that's where I should invest because I can see the allure to it. And I have no doubt I'm a surfer. I love the coast. For me, that is something that I always love to be is by the water and doing what I love to do. However, people need to raise families. People need healthcare. People need tertiary education. People need commerce. They need culture. They need to be proximally located to friends, family, and all those things. And you can't replace that in a quick 6 to 12 month cycle because of what COVID's led to. And I don't want to be the one sitting here in 2022 saying I told you so, but I just want people to really caution paying overs for property in markets which are completely and utterly overstimulated and undersupplied. So yeah, be cautious of making those decisions in regional towns which you wouldn't have even considered 12 months ago.
Yeah, be careful. Get the right advice. Now, was that just a subtle way for you to want to talk about your book? Being a surfer and liking the coast.
Not at all.
Okay, I'm not going to let you do it.
But you've done it. Surfer's Guide to Property Investment, pure property investment.
Still?
Well, it can't not be a bestseller, can it? Once it's a bestseller, it's always a bestseller.
Oh, forever. Okay.
Well, that's the
Can you
technical.
still get it?
100% you can.
Yeah, okay.
Anywhere. On our website, purepropertyinvestment.com. You can grab it Amazon. You can grab it everywhere and anywhere, Philip. I know you've got a copy.
Yeah, I do.
Yeah.
It's stopping a door from closing.
It's probably that door was probably bought in a property which was part of the recommendation from the book.
Maybe. Are we going to see an update at some point? Is it going to be?
It's in discussion.
Here we go. We heard it first.
In discussion.
Anyway, this is not a chance for you to publicise your book. But
you did it.
The point being, you've got to be smart in this market. There's a lot of people out there who aren't not normally necessarily a property investor. We're seeing a lot more people attracted into property as an asset class. That's cool. We're obviously going to fly the flag for properties and asset class, the right properties. Now, what we saw last week, so we're recording this after the first Tuesday in February, and the RBA come out and said the cash rate is not changing this month. It's the first time they've met this year. Don't meet in January. And the Reserve Bank governor has pretty much said, don't expect the cash rate to move too much over the next 3 years.
Yep. And
That's
I think
pretty significant, right?
Yeah, and I think the words were don't expect it to move. And you're talking until 2024 and now the headlines are grabbing that. And it's a random point in time for all intensive purposes, really. But then you've got to think about, well, what does that actually mean? So if we're seeing a 0.10% cash rate for the next 3 years, what does that give? It gives certainty. It gives the ability to do your forecasting on your cash flows, on your budget. It gives you also people who have a home with a mortgage, the ability for them to think about, okay, is it time for me to maybe think about refinancing my home and getting that loan down lower? People potentially even think about fixing rates if they're thinking about, oh, do I take a 2 or 3 year fixed rate? Am I at risk if I do or don't do that? But also it gives people the ability to really do their numbers on understanding that $1 million loan at 2.5% for a principal place of residence is $25,000 a year in interest only. Yeah. It's wildly affordable. And I'm not advocating that people should go get $1 million mortgage tomorrow if they can't afford it. But again, it goes back to saying that will be, in all likelihood, the mandate for the next 3 years. You're going to see that interest rate will be available, and people like certainty. Property is a game that performs so much better when there's certainty in a market.
But therein lies a challenge with this as well, to my point. There's a lot more people looking at property as an asset class because you get good leverage. And if your leverage is on a pretty low interest rate based, that's going to stimulate a lot of activity. And therefore, hence the reason why we're in a market right now. We'll go through some of those numbers in a second with a whole bunch more people out there that want to buy property than what there is properties for sale. And this is supply and demand, basic high school economics. This is what we're seeing play out right now. And that's cool in many ways, but you've got to tread carefully. So be really, really sensible about your decision making. So money's going to be cheap for a period of time, number one. Number two, you take from that the government is committed to economic recovery post-COVID, and the way they're going to be doing that is making money quite cheap to get, and therefore making people feel a little bit wealthier or having more capacity to borrow. And the wealthier people feel, the greater propensity for them to spend money. Again, high school economics. If people are spending money, you get an uplift in the whole economy. People are buying more flat screen TVs. People are buying new cars. People are just buying stuff, right? Compounded with that is that no one's really leaving the shores this year. Everyone's going to be staying in Australia. Another data point, go and have a look at it, is that savings
The highest
Household
level
savings
ever.
at an all-time high.
All-time high. Go figure. Imagine that. Start of the worst economic downturn in March ever predicted on record. By the end of 2020, we've got more money in our bank accounts than on record per capita, even factoring in inflation.
But even credit card spending is spiking, but there's still
Capacity for them to pay
it down.
Yep.
So this all bodes well for the wider economic recovery of the
And
nation now.
You've got tax cuts, permanent tax cuts, which have already been implemented as well for PAYG, for businesses. So you've also got these savings, which aren't flash in the pan savings. These are permanent savings. So more income, higher liquidity.
Again, opportunities, challenges. IMF came out recently, global GDP growth 5.5% 2021, from a base which was pretty crap last year. That's up from where it was in October. They were saying sort of 5.2% then. Australia, they reckoned 4.5 to 5-ish% GDP growth, a lot more than the usual sort of indicative number of sort of 2 to 3%. Well, inflation, but that's normally the growth of the economy.
Yeah, and like you said, I guess the key part there is it's relative, and Australia definitely fared better than almost every single westernised country as part of the downturn, and didn't see that downward spiral, as well as the economy operated relatively normally for the vast majority of 2020 in unnormal circumstances, but realistically comparing it to the rest, you wouldn't expect we're going to see the massive rebound effect of 6, 7, 8% GDP. But still, if it's in that band of 4 to 5%, it's going to be well in line with what they said, unemployment potentially dropping to those 5% by potentially 2022 again.
Well, most jobs lost at the start of COVID are back.
They are.
Despite maybe some in aviation, hospitality, tourism, etc. Another go figure. Since I remember it was my birthday actually, that the highest day ever in new COVID cases in March. Since that point in time, the stock market has rallied from dropping out during that period of time up 47%. Go figure.
Go figure. And in that quicker time, and that rally probably was more of a 6-month rally than, it's obviously still continuing on a strong trudge, but yeah, it's amazing.
Yeah, so all this, and you see it in the headlines wherever you look, and you sort of wrap it all up with consumer confidence and business confidence and job growth, creation, confidence, aptitudes of business in Australia. And for those listeners who aren't familiar with this, there is only about 3,500 large businesses in Australia. And a large business is a company that employs more than 200 people. Medium-sized businesses in Australia is about 50-something thousand businesses are medium, and that's between 10 and 200 people. Most businesses in Australia, 2.2 million, don't hold me on those numbers, are small businesses, right? We're an economy driven by the SME sector.
Yep.
They account for like 73% of all jobs or 73% of all income or whatever it is. I can't remember, but it's significant. So if the SME sector is happy and growing and evolving and have economic prosperity, that's good. They employ most Australians. That's good. And they pay a significant amount of the government's tax, right? So they're a huge enabler for the wider economic growth of the nation. So all of these things all wrap up together to give some sense of confidence, and confidence translates into buying activity and behaviour. So there's a lot of people that want to buy property in Australia right now, Paul, and that's a good thing, but it comes with a whole bunch of headaches. Now, numbers that came out recently from SQM, which is one of the data house, and it's probably a data house where we give the thumbs up to, saying they provide pretty good numbers. It's got a really good leader in Louis Christopher, smart bloke. Sometimes contrarian views in how he sees the property market, but I rely on his data. Now, he came out recently with some pretty good stuff talking about, we'll cover two things. We'll talk about listings, as in properties for sale, but let's start off at his sort of growth forecast. So frame this on the basis that there's a lot of people looking to invest in property at the moment, whether they're sort of owner-occupiers, upsizing, downsizing, going left, right, whatever, or property investors and or first-time buyers, right? So this is the whole ecosystem. Now, he reckons, SQM reckons, so the business, the 2021 scenario, his base case, right? So his base case, Paul, essentially is based on cash rate stays unchanged, number one. Number two, QE expands. We'll have a chat about that in a second. The third base case, third COVID-19 wave contained via more lockdowns. Next one, JobKeeper extended to September quarter 2021. And then also the progressive rollout of the COVID vaccine. So he's saying that this is his base case, probably likely this is the way it's going to play out, right? He says Perth growth 8 to 12% for 2021. Brisbane 4 to 8%. Darwin 6 to 9%. Melbourne 2 to 6%. Sydney 7 to 11%. Adelaide 6 to 10%. Hobart 3 to 7%. Canberra 5 to 9%. And the capital city average weighted nationally 2021 5 to 9% for property. That's not bad if you're looking at property as an asset class.
Boom time. If it's leveraged assets, I mean, you won't see those numbers look like that year on year very often if you're talking about a national average of that 5 to 9% band. I mean, there's always going to be depends on in there, because what that obviously doesn't do is break down market segments as far as freestanding versus attached, as well as it doesn't break down brand new versus established. And it probably doesn't obviously break down different market segments from the decimal points of the bottom 1 percentiles, top 1 percentiles, affordability, etc.
Markets in markets.
Always. But I mean, it paints a very, very positive card if you're looking at national numbers as to what to expect this year. And to be perfectly frank, there's probably a few of those numbers which will be smashed out of the water. And there's probably a few of those numbers which I think might be contained a little bit. But even if you factor in that base case of those 4 odd points that you mentioned as well.
Does this mean that irrespective of how smart an investor you are, so this is the Smart Property Investment Show. I like to think all property investors are smart because they listen to the podcast, but I actually notice there's quite a lot of dumb decisions made in property investment, hence the reason why we do this podcast. If you're not a smart investor, you might just luck it out just by being in the market. Buy anywhere and you'll probably chance yourself some growth.
Yep.
Is that going to be most people, do you think?
I think, and this goes back to...
pull you out, right?
Yeah, no, but this goes back to probably what you would have seen and heard about a lot of what came out of Sydney and Melbourne between 2013 and 2016, where basically anyone who bought property in either of those markets at that time, attached or detached, did pretty well. If you bought brand new, you still did okay. And then all of a sudden, people have got an opinion which they therefore validate because those couple of years preceding when they bought looks like they bought really well. It will happen, and you will see people come out of this who will probably be perceived to be very, very good at what they do. But for me, it comes down to which markets are going to see the next wave. And this is where I think, unfortunately, when people are looking at what am I going to buy, why am I going to buy there, you've got to understand your budget, your cash flow requirements, how that fits in your portfolio, those types of things. But don't just consider what happens this year, what happens next year. Property done well and done properly, in my opinion, is a minimum 7 to 10 year proposition. And if you're investing for a 3-year or a 12-month cycle, don't buy property, in my opinion, because you've got to remember that here's a big one that I always go back to. You need to make 7 or 8% in property before you've broken even. Remember, you've got acquisition costs, sales costs. So if you want to enter and exit an asset and actually realize physical cash in bank, you need to make 7 or 8%. You've got stamp duty, you've got closing costs, you've got sales costs. And each one of those figures that we just walked through, basically, if you get any of those outcomes, you probably have covered your costs, but you haven't made a penny. So you've got to think, you've got to play for the cycle. You've got to play for the 2-3 years. You've got to play for that 5-8 years, and you've got to factor in your cash flow along the way. Does that allow you to then potentially retire the debt? Is that property going to allow you to do something else to the property which will maximize growth in some other way, shape or form down the track? All these other intricacies, which are more than just, I've got ability to borrow $1 million, so I'm going to go and buy $1 million property.
That's good counsel, and it just means you've got to invest within an ecosystem. Now, you're looking at some other projections. Shane Oliver, AMP Capital's chief economist, he reckons sort of 10% per year in terms of growth, which is pretty consistent with SQM, Housing Boom and Bust Report. And this is all good, right? So I guess the point to make is, if you're going to invest in property, don't be the investor who just gets a big leg up just for being in the market. Actually be the investor who amplifies that. So just don't be a participant.
Yep.
Right. There's going to be a lot of participants out there.
Yep.
Who, the tide rises all boats and that sort of stuff. That's going to be most.
Yep.
Right. There's going to be most people that are going to get lucky.
Yep.
So
which is cool.
Yep. And that's great, right? But don't be that person. Be the person that actually is very strategic in where they choose to park their money and why. And that's what you're talking about there. You need to know why you're doing and what you're doing in this particular market. We'll have a chat about that. We're just going to go break beforehand. Back in a moment.
Are you struggling to invest in property this year and need help buying? Then you need to book in a consultation with Investors Dream and let us do the hard work for you. Don't fall victim to missing out on incredible deals like everyone else. Lock in a meeting today. Go to investorsdream.com.au and secure your financial freedom today.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show, with Director of Pure Property Investment, Paul Glossop, chatting about some of the numbers in this market and how to make sense of it. Now, Paul, how do you be the guy? How do you be the girl? How do you be the couple? How do you be whoever it is who are the smart investors in this market who just don't luck it? Give me a strategy.
Really, it starts with preparation, and it always does, because it doesn't take much to jump onto an online finance calculator and say, here's my income, here's my debts, how much can I borrow? It's pretty simple. It'll take anyone 5 minutes to go and find an engine that'll do it today. That is not a strategy. That is essentially a borrowing capacity. And to be fair, it's probably not a true depiction of your borrowing capacity. But what you really want to be thinking about, whether you're 20 and buying your first investment, whether you're 30 and buying your first investment or already buying or bought a home, or you're 40 and looking at leveraging into multiple assets, so on and so forth, it comes down to understanding what are you buying and why are you buying it? How does this fit into any other assets you might have? And trying to think about the considerations of where your equity sits, where your other portfolio may sit, land tax considerations, exposure into certain markets, as well as what your debt retirement, as well as your pay down facility or pay down timeframe and structures look like. The other things that you really got to consider is finance, and how do you structure your finance best? Because in these types of markets, and I'm not just talking about a 12-month period, but probably talking more like it's good 2 or 3 year growth cycle, is that we want to be seeing people prepare to say, if you've got capacity to buy more than one asset, prepare your finances accordingly to say, go and strike accordingly. Because the last thing you want to be doing is, or thinking, is that you might have capacity to go and buy 2 or 3 assets over the next 3 years, but that actually might be possible here and now. So as opposed to saying buy 1 a year for the next 3 years, this is probably a point in time where you might suggest, do you utilize your deposits and go after a more aggressive 10 or 12% deposit, factor in lenders, mortgage insurance, etc., to gain exposure to a growing market? Now, I'm not suggesting that's what people should be doing across the board, but previous to the last 2 or 3 years where you say, look, it's probably not worth going down the pathway of LMI just at this stage, this is probably a market where I'd suggest potentially a more aggressive stance for some, which previously maybe wasn't the consideration, will probably serve them better in the next 3 to 5 years, because they'll get a much more rapid capital growth position, extract that equity, potentially also look at expanding their portfolio at that time. So they're the things to consider. But also, and this is always a big catalyst, consider what happens when interest rates go up. Consider what happens when the market cools down, because I can guarantee, as sure as the sun rises in the morning, is that we're going to see a growth cycle. We're going to see a flat or sideways cycle. We're going to see a negative cycle out of the next 10 years. Don't just get caught up in the sense that, wow, my property's grown 10% this year, I'm a genius. It's done 10% next year, I'm a genius. And all of a sudden I feel wealthy, because that will most certainly turn a corner. And you need to know, are my cash flows okay when that market goes backwards? Is my cash flow okay when the interest rates go up? Am I comfortable when my equity goes from a position where it is now to an extra 20, 30, 40% in the bank, and I've leveraged it and I actually now have issues with regards to serviceability? Am I okay if I lose my job? Am I okay if we have a baby? Am I okay if I choose to retire early? They're the things which make people better investors, as well as far more successful long-term investors.
So to reiterate the point, just don't trust the luck. And let's remember, most property investors in Australia, as in the biggest percentage of property investors, own between 1 and 2 properties. And there's a good reason for that, because what's normally happening is that they bought the wrong property at the wrong time or for the wrong reason. So they just get stuck. So guess what? Fast forward 10 years, those numbers aren't going to change, right? They're going to be the people in this cycle who buy the wrong property. Now, okay, you listen to this podcast, hopefully to try and invest in your education. So you're not one of those people. You might be, maybe 1 or 2 properties is all you need. That's cool. That's fine. Who do you listen to? Where is the help at hand? No doubt you're going to say, oh, look, use a property strategist or buyer's agents. Yeah, that's cool. That's fine. But how can you actually, there's a lot of information. You just spoke about, probably 4 or 5 pretty significant, if you drill down to it, complicated financial, mechanical issues, right? And something that's going to blow people's mind. They go, well, what's all that about? Like, how do you actually shape a strategy in this market? Who can you talk to? Who should you trust? Who should you rely on?
I think it doesn't go back. Well, first and foremost, it always has to start with someone who can understand and give you a very clear position on your finances. If you don't know your finances, that's fine. I would dare say get much more familiar. When I say your finances, not necessarily your borrowing capacity, get familiar with your budgets, get familiar. And I'm not suggesting or implying that people should have a budget, a running budget at a given point in time, but they should have an understanding of how much money goes out every week, every month. If you're having a baby, how much is that going to affect your income versus expenditure? If you're planning on that overseas trip or that interstate trip or something that's going to be 15 grand a year and you're thinking, what, we may or may not do it. If you don't know those numbers, then start there and then utilize a good investment broker to ideally give you that capacity. Understand, here's a scenario one. You buy that 500K asset, you're going to hold it at this percentage rate. How are you going to pay it off? What does that mean from interest only to principal and interest? And how does that affect your own income? Is that still going to allow you to pay off your own home in a time that's going to be significant enough to allow you to walk away from that mortgage well before retirement age? If not, then you need to suggest, well, is that the best strategy for you? Are you comfortable with that? And once you understand those numbers, the job then is, and we much prefer to someone at least to have some sort of familiarity with how do they know their numbers or what are those numbers look like, and then setting strategies according to their budgets, according to their comfort levels, their risk appetites. And then our job is to really set strategies on property types in markets. I know we led with regional markets, which have become a bit of a flavour of the month. And I'm not discounting certain pockets either, but it's to say that that is the part which we go in at, is saying, let's look at what market's going to give you an uplift in a 3-year time, what markets are still going to be there providing good results for you in 10, 15, 20 years time, and how do they fit that finance algorithm? And then probably lastly, the accountancy side, structures. You can't undo a purchase structure without typically a fair bit of cost and rigmarole involved. So if you can, essentially be prepared to circumvent any of those issues by having those discussions before you put pen to paper. A lot of the time, it's really literally as simple as saying you don't need to complicate things. Personal names is fine, tenants in common, joint tenants, however you want to structure it. But other times it might be that it's a trust recommendation. You might look at a property which you may develop in the future. So you may be able to say, okay, a trust structure will provide better opportunity to distribute any profits from a tax effective way, et cetera, et cetera. So there's some of the big things that I would always consist of is understand your numbers, get your finance structures understood, property-focused accountant who can give you very clear and non-subjective advice that's just going to line their pockets, a property strategist, buyer's agent who is non-biased, understands all markets and different price points depending on what you're trying to achieve, and then get busy. Yeah. For me, it is a year that if you're thinking about it, this is the year that you really need to get off the sidelines.
And I agree with everything you say. I think that the issue is that most people start at that point number 5 as in they're finding houses rather than all the other stuff, Your personal profit and loss and personal balance sheet, fundamental. You got to know whether or not you can actually afford to invest in property, then finding a good broker, finding a good accountant, getting the right structure. Then you start thinking about assets. And that's where a good sort of buyer's agent can help you out, or you can do it yourself, however you want to do it. But it's a bit of a minefield out there right now. And again, there's so many shifting dynamics in this market right now that if you rely on data and only make data-based decisions, you're probably operating 3 to 4 months behind the ground truth, the reality in the market right now. If you're entering into this particular market with a pre-approval in 6 months' time, it might change the assets you can buy. Like there's a whole bunch of moving parts. Now, to complicate all this, Paul, you talk about data lag. Often there's a disconnect in certain market cycles when bank valuations are considerably lower than market valuations. For example, you go, that house $1 million, I'll buy it for $1 million. That's great. The bank goes, okay, I'll value that. Mr. Tarrant, no, it's only worth $850,000. And you go, but I just paid $1 million for it. That's what the market's worth. And they go, yeah, our numbers say it's worth $850. And we'll lend you 80% on $850. So that means you got to find that $150,000 gap plus a deposit on $850,000, 20%. That's a big issue, right? Are you seeing this in the market at the moment?
Definitely. And it's a very unique position in the market because you don't always, and it's probably only every cycle that comes along at the start of growth cycles. And start of growth cycles present issues for valuers for a few reasons. I'll go through that. But you rarely go through the point in which a market was flat, stagnant, maybe just sort of topping and tailing every other quarter to the point where it starts to take off. And the challenge always comes is that bank valuations or automated valuations and even valuers will look at previous sales. And when you talk about previous sales, you must remember that sales only are sales as far as the data is concerned when it settles. It's not the day it exchanges, it's the day it settles. And majority of exchanges to settlement takes anywhere between 6 and 12 weeks. So if you've got 2009, or we'll just say November 2020 property exchange and you've got a settlement that happens in February, I can guarantee you that within at least half a dozen markets that I know we're buying in right now, there's probably been 5% shift in some of those markets on the equivalent property. So if we're now all of a sudden saying, hey, I know that property went under contract for that, but I can actually say that this property here, that's a direct comparable in, let's say, equivalent street, 3-bed, 1-bath, single-story brick home, 600 square meters, similar orientation, same street, that just sold for 415 grand. Yes, that property over there we bought for 385, but if we're presenting a property to a client, or if a valuer is looking at a property right now for 415 grand, they say, well, it's not worth that. I can see that property sold and settled for 385. Well, the problem is the lag between it. And until that data catches up, which will be another 3 months, all of a sudden it will look like value, but bank valuers, or banks as well as valuers, will only value on a settled property. So this is a challenge right now that will come into fruition for the next probably 3 to 6 months. However, what valuers will also do is that probably by mid to end of this year, once they see that the data's there and suggesting we've got a growth market, they will factor in market conditions. But it's tough. They can't factor in market conditions until you actually show that on paper there has been growth. So it's a bit of a chicken and the egg small window, which valuers and buyers are sort of find those issues and say, how can I justify paying that at auction when I know only 6 months ago it was selling at that? Well, this is the new norm, and you've got to be prepared to say, you can say no to that, but you can almost unequivocally guarantee that if you say no to that and wait for the next one in 3 months' time, guess what? It's going to be more expensive than what you're considering today.
And this is advantageous and also a negative for investors depending on where they sit. So if you're buying at the top end of your serviceability and you don't get a good val, that's going to take you out of the market. For people on the other side, if you've got capacity and an appetite of risk to weather the difference between a bank val and an actual market valuation, the smart investors are operating in that space right now. Are you seeing that?
Yeah, definitely. And I think that's the key is knowing that you've got a bit of a buffer to say that's what we're approved at, or that's what essentially our finance goes to, but we're comfortable to stretch it a bit further. So if we have to make up the difference, we can do so. So be prepared for that. But also there's pretty simple ways a lot of the time to circumvent any of those issues. If you're going to auction, if you're looking at putting an offer in on a property, or if you've got a property at a particular price, a question to your broker at that point in time, say, hey, here's the property, I'm looking at buying it. And I can actually refer to an example this morning where I spoke to a brokerage team who's representing a client of ours. We're looking at buying a property. They know that they would only get the finance for that property if it was in a category 1 location. So my question to her was saying, here's the postcode, check it for me. She said, Paul, green light. I say, fantastic. So we know we can get the finance. We know that it would only work in a category 1. If it was a category 2, then she'd need to make up a shortfall of about 25 grand, which you couldn't do. But again, simple phone call to a broker who understands the investment process and can give that response immediately via software. It's worth its weight in gold.
You know, happy you brought that point up because property investment is largely a game of finance with a whole bunch of stuff around it. Let's get into that. Let's go to another break before we come back in a moment.
Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Paul Glossop from Pure Property Investment. Now, securing finance in these markets, much like bank valuations not stacking up the market valuations, it's just one of the dynamics of this. So money's cheap at the moment, and banks and lenders like to lend money because that's how they make money. But they'll be risk averse around it. They're not going to sort of over-finance properties, hence the reason why there's disconnect between market and bank valuations. Now, there's a lot of people out there right now looking to buy, and smart investors should have a pre-approval. What I'm seeing is that some lenders' approval rates is blowing out, and it can take upwards of 2 months to get a loan approved, right? So this is a challenge for investors. If you want to be active in this market, you need confidence around your ability to borrow. I've heard stories of people securing a property on like conditional finance, and they've got 2 weeks to sort their finance out, and they can't even get approval during that period of time, right? So it's fraught with risk at the moment. Is this common right across Australia? Now, how do you sort of navigate it? Because you spoke about a good broker doing a good job, and I completely agree with that. Is that where it starts and finishes?
Look, it has to, but I think even before that, like knowing that hypothetically, if you say to your broker, hey, I'm thinking about buying this property and the val stacks up, all those types of things, great, sure, put pen to paper on a contract. However, that doesn't mean to say that you're going to get approval tomorrow. It means that, yes, it means that fundamentally you will get the money and it's conditionally approved. However, they will need to go through their processes. And you've got to remember that this is a largely agricultural process where they need to see a formal document that's signed by both parties on a wedding piece of paper in a lot of the instances. Then they need to potentially engage a formal valuer to go out and actually complete that valuation as part of the process, come back to you, back to the bank. Potentially that bank needs to send it offshore to get processed because it's more efficient over there. Then it comes back to the bank. Then they issue these documents to your lawyers. Those lawyers then sit down, book a time to go through it and actually sit down and exchange technically. In that time, you've got all your kind of differences between all of your outgoings, ingoings and balances there. That process, if you're not aware that that might take 3, 4, 5, 6 weeks to get the green light from your broker or your bank to say, hey, congratulations, you're unconditionally approved on finance, you could have a 10-day finance clause in your contract and you might have already also put down a $10,000 deposit. And so often people think, oh, okay, I'll just chuck that money in there. I've got a 10-day approval time frame. The broker comes back and says, good luck with that. We're going to need another month. And all of a sudden you go back to the agent or the vendor and say, I need another month or I need another week or I need another 2 weeks.
They say goodbye.
They might say goodbye. I'm going to take your deposit and I'm going to say on to the next one, especially in a growth market. And that's the thing is if they're aware that the market's doing an upward trajectory, I was going to say doing this, but we're
going to go brilliant. We get another chance.
100%. And that's why auction campaigns.
Sell it again.
Agents in auction campaigns at this stage, well, not agents per se, but vendors, they're going to say, look, it's a 5% deposit. If you can't satisfy, it's an unconditional, well, unfortunately it's unconditional, but if you can't fulfill settlement, then there's nothing stopping them from keeping that money and rocking on to the next auction or so on and so forth.
And as a tactic now, contract negotiation has firmly fallen in favour of the vendor.
Absolutely has. And that is
They're
such a
dictating
big,
terms.
Massively. And it's always been and always will be such a high priority for us when we're securing property is price starts with price, but then contract terms is everything. And I'm actually working on a settlement of an off-market property in Sydney for a client as we speak. And we've been working back and forth for the last week. I'm working directly with the vendor, so no agent involved, which makes it actually extra difficult. But they've obviously got no extra costs that are coming with selling the property. So it gives us a bit more negotiating power with that. But then I've got to explain to them the fact that my particular client wants a 90-day settlement because finance ultimately will not be done immediately and it's going to be complicated. And I need to explain to them saying, look, we're going to be happy to go unconditional because my buyer will be fine with finance, but they will need time. So then trying to make sure that they're comfortable with a 90-day settlement as opposed to a standard New South Wales 42-day settlement. Because if we just put a 42-day settlement and we said, hey, we need another month, then in all reality, if the contract's not negotiated properly, they can charge penalty interest every day thereafter. And if they need another month, then we could be charged thousands of dollars on a compounded rate for the next month to get finance approved. Not that the finance won't get approved, but if it's not in time, then we haven't stacked the contract in our favour. And if they do want to walk away, then they can just say, look, you know what, we're tearing this up and we're actually just going to take your deposit and go back to the market.
So the question, Paul, is the juice worth the squeeze in this environment? Like everyone's out there trying to buy property. Supply and demand, not all around. And let's have a quick chat about that. It's a nice segue into it. But where I'm going with this is that it's competitive and a lot of people are spending a lot of time, energy, effort and attention and focus towards this. And the likelihood of them securing an asset that is good is probably quite low. Is the juice worth the squeeze? So here we go. Listings. So again, this is the SQM data talking about changes in listings. So this is stock on market, right?
Yep.
This is how many properties are available for sale, right? So in January, there was January 2020, 296,000. December 2020, 272,000. January 2021, 265,000 properties across Australia. So that's dropped considerably, 30-odd thousand.
Over 10%.
Over that period of time, right? So that's a change of 10.5% yearly change nationally, right? Now let's go into the different states. So let's go back to high school economics, supply and demand. If there is more stuff to sell than what there is buyers of that stuff, prices go down.
Yep.
If there's more buyers there than what there is stuff to sell, prices go up. Simple. So there's less properties available for sale, number one, and there's more people wanting to buy it. Double whammy, compounded. Sydney is up 4.5% in a year.
For the year? For the month?
For the month.
Yep.
Now, Paul, tell me about this. We'll go back to it. Melbourne, 21% up.
Yep.
Okay. That's a strange time. Brisbane, 13% down. Perth, 4.1%. Adelaide, 16% down. Canberra, 10% down. Darwin, 14% down. And Hobart, 24% down, right? So national average or weighted average, 10.5%. Now, there's 23% less properties available for sale in Hobart now than what there was a year ago, okay? In Melbourne, there's 21% more properties available. So this tells me there's less people wanting to sell in Hobart and there's more people wanting to sell in Melbourne. I reckon everyone wants to get out of Melbourne because they're sick of that COVID lockdown, right? So they put their houses up. So Sydney, there's 4.5% more. So as a buyer's agent, how do you use numbers like this to help shape where you should be investing? So should you go, shit, I'm going to buy in Melbourne because supply and demand is different?
You've got to factor that into a whole bunch of different equations, because the reality of that data is that it's an aggregate of attached, detached, new and established. And that's probably the big one here too, is that I guarantee if you look at Sydney and Melbourne in particular, the inner city high-rise accommodation would have the lion's share of these properties on the market and vacancy as well.
Yep.
But if I look at other markets, you will see that if you look at this report, the correlation between markets which are undersupplied in that same report, you're seeing that the expectation for the most part is that those markets will see stronger capital growth, at least for the short to medium term. So there always is going to be that correlation as long as people can access credit. The other equation that doesn't factor into that too is what the equivalent gross rental yield in each of those markets is too, because then that'll also paint a different picture of what is the cash flow of that property. If you're buying an average median price of that at that yield, here's what to expect from an income expenditure scenario as well. But there most certainly is a strong correlation in each of those markets to expected price growth, to expected or current, on trend, absolute supply on the market. I wouldn't expect Hobart's going to see the lion's share of capital growth. However, January is a bit difficult because it is seasonal. But if you look at year on year, COVID was obviously a very strange year, and there was a lot of property which didn't go to market for about a 2 or 3 month period in Melbourne due to the fact that essentially the whole state was locked down, or the city rather was locked down. And that now is seeing a bit of an influx, which will taper off again. And if you look at January in particular, January was a much more uniformed month. If you talk about monthly change, the only real market which was flat was Perth, but every single other market was in deficit when you look at it. And it's very consistent between 1 and 3 or 4%. In particular, Melbourne's down 4.7% for the month of January. In short, when you're talking 10% deficit in total supply or 30,000 less properties on the market versus exactly the same day or month last year. And remembering last year at this time, there was no COVID. Australia did not think that this was going to be something that was going to impact us. So there is no COVID specifics on where we are right now.
And herein lies the challenge. You can't invest in isolation with a handful of data sets, right?
Yep.
There is stories behind the numbers, and you make a point there. Maybe the reason why there's so many more properties for sale in Melbourne than what there was beforehand is that no one really listed a property for 6 months in Melbourne because it was in lockdown. So it's heaps on the market, point number one. Point number two, in absolute, you're talking about Hobart being down 23.7%. That sounds like that's a lot, right? But if you look at the numbers, that's 2,130 properties versus 1,600 properties, right? There's not a lot of properties for sale at an aggregate level in Hobart. You look at the same numbers in Melbourne, 37,000. So there's market size, market scale, market scope, market dynamics. These numbers in isolation aren't enough to help determine how you should be investing. It's good to know, but you got to join the dots. Now, you made the point, Paul. How many of these 37,000 properties for sale in Melbourne or the 25,000 for sale in Sydney are units versus houses? This is a two-speed market right now. There's houses and there's units. You dig into the numbers and you have a look at it. You speak to the economists, the demographers, and all these type of things, town planners. There's this sentiment now that people don't want to live in high-rises anymore because they're going to catch COVID because there's more people there. People want wide open spaces in a house, right? Because you're not going to catch COVID in that regard, right? Whether or not I subscribe to that, time's going to tell to see how that's going to change.
Space is key, though.
Space is key. So houses versus units. To the point, because of the market, and there should be an inherent lift nationally as a result of all these dynamics, a lot of people will fluke it, right? Even people that buy units will potentially fluke this market. Should you be investing in houses in this market versus units? Give me some dynamics, some shifts, some pros and cons.
it comes back down to not necessarily just focusing on what people are going to want due to COVID. And I think there'll be some permanent legacy of COVID in what people want in space and all those other things that come with having an extra room for a home office and having space for the kids to play, etc. I actually did an article, I think it's published on SPI on your website, maybe about 4 or 5 years ago, looking at historical performance over a 10-year time frame in Sydney in particular. If you spent the equivalent, I think at the time we did the regression on about $300,000 investment in a house versus a unit at the time across Sydney, and that was looking at markets which you could buy a $300,000 unit. And at the time, I think they were like one-bedders in Randwick, Mosman, inner city, inner west. There was a couple of markets there where we did the analysis on versus buying a house in Campbelltown, Penrith, St Mary's, and as well I think we looked at units in Cronulla in that same scenario. The reality is that the houses perform better on a capital growth basis. From a yield basis, they were a bit softer and permanently softer, and ongoing, even factor in strata and outgoings, they still were a bit softer. So you will see, and that's not to say that in itself is testament to houses perform better than units. However, if you take COVID out of the equation, land is what you're going to see increase. The value of the land, the ability to utilize the land for more than just what is on there with a house will always be the case, especially if you're buying in undersupplied, and talking about the supplied data, undersupplied area where you're holding land and that land can be utilized for something more. You'll unequivocally, if you're looking at 100 situations, I could say that at least 95% of those situations, you're going to see a better outcome in a freestanding house versus an apartment or a unit.
And let's overlay this with another suite of data or dynamics, which we're not seeing in the market right now. So this is all happening without any overseas migration.
Exactly.
Now,
Go figure.
Up until COVID, and the numbers vary year on year, but we were sort of getting a couple of 100,000 new people come to Australia, migrating to Australia pre-COVID. Right now, there's none. Well, a handful, right?
Yeah.
And the market's doing what it's doing. Now, a lot of people who do migrate here often might move into a unit originally, try and get their stuff sorted out, or overseas students and all that sort of stuff. Right? You're not even seeing that stuff, right?
Yep.
So how do you make sense to this sort of houses, units dynamic, considering that one of the key drivers of property price growth over time is population growth? People would argue that that's part of it, but it's a factor. What's going to happen when everyone gets the jab, mate? And,
it's the crazy thing, isn't it? Because some really crazy data that I saw come out, I think it was about August, September last year, was that, and I was not aware of this personally, I'm completely honest, I was not aware of this, but Australia operates at a net deficit on immigration versus people in their prime, be it 18 to 32-year-olds exiting to go overseas. Now, whether it's for a 1-year visa over to the UK to pull beers and go and travel, or it's people who are actually migrating for work or doing whatever or studying, etc. But we actually operate at a net migration of about 0.1%. So we actually lose about 0.1% versus the actual people who come here to study, to work on 457s and do whatever else. So it wasn't until the penny dropped there to realize, well, you know what, we actually lose one of the biggest engine rooms of our economy on an annual basis every single year. And because of COVID, that actually stopped as well. So the reason being, when people are like, well, why the heck is supply actually going down, and why are rental vacancy rates now starting to normalize? Because we did see this mass exodus of these hotspot student as well as 457 visa holder locations. There was big vacancy straight away. And that happened, big spike, and they're still going through getting back to normality in those markets. But for the vast majority of other areas, they actually are doing fine. Freestanding houses, families doing fine.
So you're seeing that now, and I think for one of the properties in the Smart Property Investment portfolio in Central Coast, mate, you can't get a rental property on the Central Coast, right? So what you're talking about here is knowledge workers and backpackers going to do whatever they do. They're all staying here. So that's recalibrating the status quo.
Yeah. And they've got more money now too, based on savings data. These people, exactly. Yeah. So they've got more money on average than they've ever had. So they've got cash in bank, probably borrowing capacity, which is improving as well. So instead of thinking I'm going to go spend 2 years abroad, I was thinking, well, why don't I just start my career, buy a house, rent a house, whatever it may look like, which is now putting that demand in. So if we fast forward 9, 12 months, if we all get the jab, the reality of Australia, by the looks of what we've done and organised our economy, is that we're probably going to be very, very restrictive in who leaves and who comes. I think we're going to want to see a safe place before we get any of that happening. So as much as we'll probably be able to go to certain bubble markets by the end of 2021, start of 2022, we're not going to see a free trade, which I don't think we're going to see much difference in our migration as well as our total position on how we see population growth.
Yeah, it's complicated. And I think safe harbour here in Australia, I think less people who might have traditionally gone off into the world and pulled beers or worked at ski resorts or whatever, backpackers, right? You know, doing their 2 years, whatever they do, or knowledge workers. If we're able to retain them more, and I think they will do, because they're probably the appetite for trouble. You know, we're going to emerge out of COVID faster than most other nations. So most of those people aren't going to want to leave here pretty quickly. But what's going to happen is that when the Australian government goes, hey, we're back in business and it's a nice safe zone here, if you're not going to bring COVID into this country, I reckon people are going to be lining up.
Absolutely.
Lining up to come in. So again, this is going to be, hence the reason why this sort of perpetual wave of this next period isn't going to be immediate. I think it's going to be slow and it's going to be burning and it's just going to keep snowballing.
I just got tingles as you said that. As we're talking through this, you can see pretty clearly, like, human behaviour will say that we're going to see less propensity or desire for us to want to go overseas, because we probably just won't trust majority of countries, even the ones that were historically probably trusted, because you can
no
just
COVID in North Korea though, Paul.
Well, we still can't get in there. They might open the borders to us because we might be COVID free, but you still think straight away. Like, I think that, and I'm a big advocate for travel. So are you, Phil? I mean, we'd say, look, I'd clearly, if I had a month off, and I'm more than happy to go back. I've got family in Canada, and it's something that we want to do very, very soon, and we haven't been able to do it for a long time, but to get there is a massive pain. To go through the processes of a quarantine, the trust of actually not getting COVID along the way is something that actually is very, very relevant. However, so we're going to see two things. I think we'll see, like you said, the moment we know that certain countries have gone through mass vaccination, we've got proof of it, and we know that the efficacy and the safety is there, then we're going to probably open our borders quicker than what we're going to want to leave our borders. So we're going to see this another wedge of more demand and no supply. So we're going to see another wave of continued push in our property market, I dare say.
Great time to be an Australian, mate. I've always said that. But we've spoken about this and conscious of time in the context of like specific property market dynamics, like what's going on. We sort of touched on how the vaccine will support and promote economic recovery and travel and all this sort of stuff. We haven't even spoken about sort of the upcoming federal election, Australia's satisfaction with the current government, what's happening in America with the new Byron government, geostrategic issues which are going to shape Australia moving forward, challenges with China, potential trade wars, blah, 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 blah. There's not so let's park that, and I'm going to give you some homework to go away and have a look at that, those sort of macro activities which are going to shape Australian property market moving forward. We get back in the studio and we chat about that stuff.
Sounds good,
really
mate.
Handy. Thanks, Paul. That was good. It was a long one, but if you're new to this, like this is just essentially a couple of guys who I'd like to think sort of know a little bit of what they're talking about, discussing these issues around property. No recommendations or advice at all in anything we're doing here. However, any questions at all, send them through editor@smartpropertyinvestment.com.au. We can get them answered like in a way in which is very specific on smartpropertyinvestment.com.au, or I can get people into the studio to answer those questions as well. So do that, editor@smartpropertyinvestment.com.au, or wherever you listen to this, you can leave a remark there and we'll make sure we get it answered. We'll get Paul back in the studio then. Signing off, Paul, thank you very much. Remember, smartpropertyinvestment.com.au. Social media, Smart Property HQ is where you can find us if you want to know what's going on. Keep at it, keep engaged, keep vigilant. Don't make rash decisions in this market. Be strategic and lean on people who are going to operate in your best interest. Again, there's probably someone else we can talk about whether or not you're getting unbiased advice, but that's for another podcast. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.